Good afternoon and welcome to the first session of the Autumn Terms Money Webinar Series by the Institute of International Monetary Research in collaboration with the Vincent Centre at the University of Buckingham. We have an excellent speaker and an excellent topic to start the series with. I'm Dr. Juan Castañeda, Director of the IIMR, and today we'll be hosting Dr. Christopher Neely. Chris Neely is the Vice President of the Federal Reserve Bank of St. Louis, where he has worked as an economist since receiving his PhD from the University of Iowa in 1993. Neely conducts empirical research in international financial markets. This research has focused on financial volatility and conventional monetary policy and market efficiency. He has published in leading academic journals and is or has been an associate, visiting, or co-editor of many journals, including the Journal of Money, Credit and Banking, and the Journal of Banking and Finance. While working at the Fed, Neely has taught economics and finance as a visiting professor at several universities. Chris Neely will discuss today international differences in unconventional monetary policies, after which we will allow time for Q&A with viewers at home. Today's presentation will be recorded and made available on our YouTube channel. You can access this presentation and the previous ones in this series on our YouTube channel. Questions must be submitted by the chat option on Teams, and I will moderate them and address the speaker. Chris, we are delighted. I'm very grateful for your continued collaboration with the Institute, and we're very happy to host your talk today, if only online. The topic couldn't be more timely, and I'm sure that it will be most interesting for our audience. So the floor is entirely yours. Take your time to do the presentation, and then we'll have some questions from the audience. Thank you very much.
Okay, well, thanks very much, Juan. I appreciate it. I trust everybody can hear me and see me in the screen. Okay. It's a pleasure to be here. Next slide, please. I should first give the disclaimer that anything that I might say reflects only my own views and not those of the Federal Reserve Bank of St. Louis or the Federal Reserve System. Next slide, please. This is going to be a little bit of an unusual talk. It's going to be a smorgasbord of topics. I'm going to talk about unconventional monetary policy as it's practiced by central banks around the world. I will talk about the similarities between the policies as they're practiced, but also the differences. I'm going to try to focus on the big picture. So some of you may be familiar with the institutional details of programs or central bank policies. It's very easy to get lost in the weeds on these policies. So I'm going to try to avoid that. I'm going to try to stick with broad themes. So what are we going to do today? Well, the first thing that I'm going to do is I'm going to define the issues and unconventional monetary policy. I'm going to talk about some of the potential reasons for differences in unconventional monetary policy. And finally, we're going to move on and spend most of our time talking about differences in unconventional monetary policy between the central banks. Next slide, please. So first, I should distinguish monetary policy from emergency lending, or as it's sometimes known, lender of last resort policies. Both types of policies involve central banks essentially shuffling assets around, either borrowing or lending or buying or selling assets. In other words, both types of policies change the composition or the size of the central bank's balance sheet, and the central bank, as part of a government, changed the size of the consolidated central bank government balance sheet. But the emergency lending is typically thought of as being done narrowly and for a short duration. So for instance, lending to a particular firm or a particular sector for a short time. Monetary policy, in contrast, has a broader impact and a longer duration. Conventional monetary policy, as you might know, focuses on influencing the economy through the manipulation or influencing of positive short rates, whereas unconventional monetary policy is more or less anything but influencing the economy through positive short rates. So it includes influencing the economy through medium or longer yields or through negative rates. Next slide, please. So why do central banks pursue unconventional monetary policy? Well, unconventional monetary policies are really fairly new. The central bank, or the Bank of Japan, was the first central bank in sort of modern history, and by that I mean, say, the last 50 or 60 years, first major central bank to pursue unconventional monetary policy, and it did so from about 1999 to about 2006, when it was fighting deflation in Japan. Now, why do central banks pursue unconventional monetary policy? Well, the short answer is that they do it when they're no longer able to use short rates to try to achieve their goals of price stability or influencing the real economy. So they do it when short rates hit zero. And there are several, so you can take a look at the graph on the right-hand side of that slide, and the graph shows central bank policy rates from, let's see, I'm having a hard time seeing what the, from about 2006 to 2020. And you can see that in about late 2008, early 2009, more or less all central banks dropped their policy rates precipitously, and some of them hit zero or came very close to zero in 2008, 2009, which left central banks reliant on unconventional policies, such as buying long bonds or providing forward guidance to market. And what forward guidance is basically telling markets through either words or actions what the central bank is likely to do in the future. Central banks also generally somewhat later in the episode, some of them pursued negative rates, and some central banks pursued asset purchases in particular markets, which I term narrow asset purchases, in order to influence credit conditions in particular markets. So, for example, the ECB's securities markets program is an example of that. Next slide, please. So, what types of differences in unconventional monetary policy are we going to talk about? Well, we'll talk about differences in the timing of policies over time. Typically, central banks are moving in the same direction at the same time, but that wasn't really true in their use of unconventional monetary policy. We'll also talk about the types of policies used, how, for example, just to take one example, some central banks used negative interest rates while others did not. We'll be talking about policy rules, in other words, how they pursued particular policies, whether, for example, their purchases of bonds were lump sum purchases announced in advance, or whether they were pursued on an open-ended basis, where a central bank might say that it's going to buy, say, $75 billion worth of a particular type of bond a month, and it's going to do that as long as economic conditions warrant. Yield curve targeting is another type of policy rule that differs among central banks. So the Bank of Japan has pursued specific yield curve targeting, and we'll talk about that a little bit more later. Finally, one difference in unconventional monetary policy is the purpose for which it's used, whether it's used for broad monetary goals or for financial stability. Next slide, please. So, what sorts of reasons are there why central banks might pursue different sorts of unconventional monetary policy? Well, for one thing, the different economies are going to have different natural rates of interest that depend on things like the underlying growth of the economy, which depends on technological change and regulation and population growth. And so they're going to have different sort of natural or equilibrium rates of interest. and perhaps different inflation targets. And these differences among economies are going to mean that their short rates are either normally going to be closer to or farther from the zero lower bound, the point at which central banks typically take up unconventional policies. Also, different economies have different structures in terms of how firms and people obtain credit. So, for example, in the United States, at least traditionally, by the way, this difference has narrowed somewhat since these figures were created, since the figures I'm citing were created, but they still exist to some degree. So, for instance, in 2007, if you measured, for example, bank loans as a percentage of GDP in the United States and Euro area, in the US they were 63% of US GDP, but in the Euro area they were 145% of Euro area GDP. In contrast, the situation with debt securities was exactly reversed. In the United States, debt securities issued or outstanding constituted 168% of GDP, and while in the Euro area, they only constituted 81% of GDP. So when, for example, the Federal Reserve decides to what sorts of unconventional monetary policies to pursue, it has to keep in mind that the United States economy is, or at least traditionally has been, more focused on obtaining credit through bonds, whereas when the ECB makes a similar decision, they keep in mind that the European economies are typically more centered around bank credit than bonds. Also, another issue that the ECB has to take into account is that it of course has multiple bond markets, and so there isn't a single bond market for sovereign bonds, as for example there is in the United States for treasury bonds, at least at the national level. The United States also has a difference in that it has a shadow banking sector centered around money market mutual funds that either doesn't exist in other parts of the world or is typically much smaller and much less important in other parts of the world. Finally, there are different legal restrictions between the central banks, and I'll talk a little bit about that and its effect on, for example, the U.S. use or non-use of negative interest rates. Next slide, please. So let me make a bit of a tenuous case for asynchronicity in monetary policy. So the graph that you see on that slide shows essentially a normalized central bank assets for the four major central banks: the Fed, the ECB, the Bank of England, and the Bank of Japan. And the assets are normalized so that they all equal 100 at the beginning of 2007. So you can see by taking a look at that graph that while there was a big jump in three of them in 2008, that at other times and there is a general uptrend, at many times it seems like some of the assets are going up, which would indicate expansions of the balance sheet or easier monetary policy, while others are going down, which would indicate contractions of the balance sheet or removal of accommodation or tighter monetary policy. So I just show you this graph to basically show you that the direction of the asset changes doesn't always go in the same direction. And this makes a basic, but I will admit a very crude and tenuous case for asynchronicity among central banks. Next slide, please. So here is another version of that same crude case. So the left-hand table shows correlations between changes in asset holdings among the four major central banks. So, for instance, the number 0.35 shows the correlation in asset holdings between, for example, between changes in asset holdings between the Fed and the ECB over the period 2008 to through 2019. So that says that that the Fed's asset changes and the ECB's asset changes were positively correlated over that whole sample, and it's a decent-sized correlation of 35%. So you can see that there are some good, decent-sized correlations in that first table. The Fed, the ECB, and the Bank of England all seem to be moving mostly in the same direction at the same time. However, if you take out the 2008-2009 period, you get the table on the right, which essentially shows that all the correlation between the Fed and the ECB and the Bank of England, the correlation of the Fed with the ECB's balance sheet and the correlation of the Fed's balance sheet with the Bank of England's balance sheet not only goes away, it becomes negative. So the only real positive number left in the table is some positive correlation between the Bank of England's balance sheet and the ECB's balance sheet. Next slide, please. So let's talk a little bit about how their central bank policies changed over time. So in I'm going to call stage one of the reaction to the crisis. I'm going to label or define that as the period from 2008 through 2012. And the graph there shows you central bank asset holdings from 2007 through 2012. And it shows you that asset holdings for all four central banks increased, and sometimes quite substantially in the case of, for example, the Bank of England and the Fed. So the Bank of England and the Fed were buying long bonds broadly during this period, whereas the Bank of Japan and the ECB were focusing more on providing liquidity and emergency lending, and they did not do as much broad stimulus to their economies. And I haven't got any evidence to directly cite to back this up, but I think that there was a feeling in the policymakers in those banks that perhaps the financial crisis was more of an issue for the United States and the UK than it was for the Euro area or Japan. Next slide, please. Now, let's talk about a particular policy during this initial period, stage one, that didn't really have any counterparts or that was unique to the European Central Bank. So let's talk about the Euro area securities markets program or other monetary, and which was followed and succeeded by the other monetary transactions program. So what was this program? Well, it was basically a series of narrow asset purchases that was motivated by the debt crisis that broke out in the period of, say, 2008, 2010, 2011. And it essentially consisted of the European Central Bank coming in to purchase sovereign bonds in particular markets in order to tamp down or restrain growth in yields in those markets. One thing that, so it was done for sort of narrow purposes. It was done for narrow direct purposes, I should say. Certainly, one could make the argument that it's necessary to maintain financial stability in order to maintain broader economic stability and allow the ECB to achieve its goals of price stability. But and I would agree with that argument. But the direct purpose was sort of narrow purposes to support debt markets of countries that were experiencing fiscal problems at the time. So I have a little discussion here about why, for an economist, it was a little bit challenging to estimate the effects of the security markets program purchases because they were purchased on an as-needed basis. In other words, every day, or perhaps even within the day, the ECB would make decisions about whether to purchase and how much to purchase. So this created significant problems for economists, but that isn't really something that you're interested in. So I'll sort of skip over that. So the SMP program was replaced by the OMT program, and the OMT program is at least conceptually similar to SMP with two differences. The first difference is that in the OMT program, the other monetary transactions, countries that seek to have their bonds purchased under the OMT program must provide a fiscal plan as to how they're going to get their fiscal house in order to make sure that the purchases will be temporary. The second way in which the OMT is different from the SMP is that I believe that there haven't been any actual OMT transactions. There were SMP transactions, but the OMT program has not had any actual transactions. Next slide, please. So here is a graph lifted from a paper where the citation is at the bottom of the slide. And this paper shows you the weekly purchase amounts and the cumulative purchases among the SMP by the ECB from the beginning of 2010 through about April 2012. And you can see that the SMP purchases were highly sporadic. They would be done at fairly substantial levels, but not particularly, but they were not done regularly, and the ultimate amount of the purchases was not particularly large, something a bit over 200 billion euros, which is not particularly large for this in comparison to the size of the euro area economy. And also these purchases were supposed to be sterilized. In other words, their effect on the European euro area money supply was supposed to be reversed by the European Central Bank. Next slide, please. So let's move on to stage 2 and talk about the time period from 2013 to 2017. And the graph on that slide again shows you central bank assets from this time from 2013 through 2017. And the takeaway from this is that basically during this period, the Fed stopped providing unusual accommodation fairly early within this period and started to move toward normalization in, say, 2014. The Bank of England, the blue line there, basically stood pat for much of the period. In other words, the central bank assets didn't increase until late 2016. The Bank of Japan, however, starting from almost the very beginning of the period, began to increase their began to increase the assets on the central bank's balance sheet very rapidly. The ECB started off the period with declining assets, in other words, normalizing their balance sheet, but then soon, within a year or two, began to increase their asset accumulation again in order to fight deflation. So I guess the point of this graph is just that this graph kind of epitomizes, just in a way not dissimilar to the previous one, this graph epitomizes the fact that central banks were moving in all different directions and they were not synchronized. Next graph, please, or next slide, please. So let's take a little bit of a closer look at the Bank of Japan and their problems. So the top graph on this slide shows Japanese GDP growth from 2008 to 2020, whereas the graph on the bottom shows two measures of Japanese inflation from over the same period. Now, Prime Minister Abe was elected in late 2012, and he had, I believe, initiated with the Bank of Japan strong expansionary measures starting very early in 2013 or even late 2012 for more seriously expansionary monetary policy. So you can see in particular from the CPI inflation chart that CPI inflation was negative by almost any measure from, say, 2009 to 2013 or through 2013. So that's a long period of deflation for Japan. And so when Prime Minister Abe took office in 2013, he engineered an expansion in cooperation with the Bank of Japan. Next slide, please. So here's one symptom of that expansion. This graph shows you Bank of Japan loan support programs. The growth stimulating funding facility is in blue. The stimulating bank lending facility, so these acronyms just kill me, is in orange. And so you can see that, and the sort of orange-yellow line shows annual loan growth in Japan, and that is paired with the right axis. So you can see that prior to, say, 2013, annual loan growth in Japan was frequently negative, and the banking support programs were relatively small. But starting in 2012, 2013, loan growth increased substantially, and the banking support programs increased very substantially in size. Next slide, please. So the ECB had at least somewhat similar problems. The top graph there shows ECB inflation, or euro area inflation, from 2006 to 2020. Two measures of euro area inflation. And just as a reminder, the ECB's inflation target is to achieve inflation, or during this period, it was to achieve inflation near to but below 2%. So generally speaking, I think that the ECB felt that in 2010 through 2014, that inflation, that core inflation was essentially too low, and headline inflation was dipping lower in 2014, dipping even lower in 2014, 2015. And so there was a desire to get inflation back up, to initiate bond buying, or to put in negative interest rates in order to get inflation back up. Next slide, please. So central banks were going in different directions during the 2013 to 2018 period. And sometimes, however, they had similar problems even at different times. So, for example, to give you an example of similarities in problems, let me draw a comparison between the so-called taper tantrum that some of you might remember from 2013 and a Draghi press conference in March 2016. So in late 2012, early 2013, the Fed was still conducting very expansionary monetary policy, but it was getting good news about the economy pretty steadily through that period. And Chairman Bernanke, early in the summer of 2013, suggested, I think, first in a press conference and then perhaps in a congressional testimony, if I recall correctly, that it may be appropriate soon to withdraw some of the unusual accommodation that the Fed had provided. And if you go back and you look at what he actually said, it seems, at least to me, like he used very measured language. And financial markets, however, were quite surprised by it. I guess they weren't expecting it. So financial markets reacted strongly. U.S. yields increased substantially. The dollar appreciated substantially. And ECB President Draghi had a similar issue in a March 2016 press conference. The overall tone of the press conference was to announce expansionary measures, but I believe that there were items within the press conference that seemed, at least to the financial markets, to be inconsistent with each other. And so again, there were huge financial market reactions to this press conference. Now, generally speaking, the Fed and the ECB don't like to surprise markets. And so these two incidents were a bit unusual. But the Bank of Japan has more of a reputation for surprising markets. So, for example, shortly before the Bank of Japan's announcement of negative interest rates, there was an article in the Financial Times, which I'll quote below, and it says, Mr. Kuroda likes to surprise markets, but he has been emphatic in ruling out negative interest rates. And of course, this was relatively shortly before the Bank of Japan initiated negative interest rates. So, you know, it seems kind of strange for me to use two examples of the Fed and the ECB roiling markets and then claim that they don't like to roil markets, and then talk about that the Bank of Japan has a reputation for surprising markets. But that is, in fact, the way I see it. So next slide, please. So here are reactions to the so-called taper tantrum in blue and the ECB press conference of March 10th, 2016. So these show the yields for, let's see, are these stock yields, I believe. I believe these are stock prices. So these show stock prices, I believe. And you can see that in both occasions, there were substantial movements in financial markets as a result of these press conferences or news. Next slide, please. One thing that the Bank of Japan has done differently than other central banks is that it has targeted short rates and long rates simultaneously starting on September 22nd, 2016. And this has been fairly effective in that they have been able to keep short and long rates more or less where they want them, but it has come at some cost in the sense that the Bank of Japan has had to buy very large quantities. In fact, more than the net issuance of Japanese government bonds over the period 2017, for example. So, for example, in 2017, net issuance of Japanese government bonds was only 33 trillion yen, but the Bank of Japan purchased 57 trillion yen worth of those bonds in order to maintain its short rate and long rate targets simultaneously. And as a result, the Bank of Japan owned 43.9% of the market in December 2017. Now, I should note that although this is unique in the modern world, if you go back just a little bit in history, you find that central banks were commonly targeting both short and long rates simultaneously. So, for example, I know that in the United States, the Federal Reserve cooperated with the U.S. Treasury during World War II and for a few years afterwards in order to keep long U.S. interest rates low in order to make financing the war more affordable. Next slide, please. Let's talk a little bit about negative rates and differences in negative rates. So one difference in how unconventional monetary policy was conducted was the use of negative rates. The ECB and the Bank of Japan both employed negative rates, whereas the Fed and the Bank of England did not. So the Fed's interest on reserves, for example, bottomed out at 25 basis points. The graph at the bottom of this slide shows deposit rates for the four major central banks, and by deposit rates I mean the rate of interest that banks earn, or if it's negative, the rate of interest that banks pay on reserves that they hold with the central bank. So you can see that, for example, the Fed's deposit rate never went below 25 basis points. The Bank of England's deposit rate never went below 25 basis points until the very end of this sample during the COVID crisis. But the European Central Bank went negative in 2014, and the Bank of Japan went negative in 2016. Next slide, please. Here's another graph of negative interest rates, and these are countries, these are all of countries that had negative interest rates, just to give you an idea of the scope of negative interest rates that were possible. So, for instance, the Swedish Riksbank had the lowest negative rates of all, and it looks to me like they're bottoming out at negative 125 basis points. And the Swiss National Bank, I think, was at negative 75 basis points, if I recall correctly. Next slide, please. So there were no negative rates in the United States. Why were there no negative rates in the United States? Well, there are a number of reasons that might contribute to this. One reason is that early on in the recovery from the financial crisis, an internal Federal Reserve memo discussed the possibility of negative rates. And among other things, they suggested that it might be very difficult to push rates lower than, say, 25 to 35 basis points negative in the United States without provoking basically widespread withdrawal of deposits from the banking system. There's also a question about the legality of negative rates in the United States. Now, I want to be very clear that I'm not a lawyer. I have no opinion on this matter. And if I did have an opinion, it wouldn't be the opinion of the Federal Reserve. I don't speak for the Fed on this. But there have been questions, there have been debates about whether the Federal Reserve has the legal authority to impose negative rates on commercial bank reserves with the Fed. Finally, there were, at least early in the recovery from the crisis, and frankly even still today, concerns about the effects that negative rates would have on a shadow banking industry in the United States called the money market mutual fund industry. And basically, the idea is that if money market mutual funds essentially take what are effectively something close to bank deposits, but they're not banks, and they invest them in short-term commercial paper and maybe short-term government bonds, things like that. And if rates were to go negative, then the money market mutual fund industry would have to essentially tell their, and I'm going to use the word depositor, even though I don't think this is technically correct, they would have to tell their depositors essentially, look, you deposited $1,000 with us, but you're only going to get back $980 at the end, if you withdraw your money now. And there were fears that this would cause a widespread run on money market mutual funds. So that was a big issue, I believe, in the discussion of negative rates early on in the financial crisis. Next slide, please. Finally, we'll talk about bank lending incentive programs. So a number of central banks have had lending incentive programs. The funding, so for instance, the Bank of England has had the funding for lending scheme, the term funding scheme, where they have offered essentially incentives either in the form of prices or quantities. So they would either lend you money at lower interest rates, or they would lend you more money if you're a bank, if you increase your lending to the non-bank financial sector. So all three, aside from the Fed, all three major central banks have had lending incentive schemes in one form or another, but there haven't been any Fed incentive programs. Next slide, please. Here is a graph of the lending incentive schemes as a percentage of their respective GDPs for the major central banks. You can see that the lending schemes were not particularly important before 2013, 2014, but especially starting in 2014, 2015, they started to become very important. Next slide, please. So the Fed has a lot of market support programs, quite an alphabet soup of market support programs, but it has nothing quite like the incentive programs. And I'm not really sure why that is. I've put in some calls, some emails to friends of mine who might know, but I haven't gotten any satisfactory answers yet. Next slide, please. Finally, we can also talk about Brexit. So Brexit illustrated a difference between central banks in that the Bank of Japan and the Bank of England both had non-trivial responses to Brexit. The Bank of Japan, curiously enough, responded to the yen appreciation that resulted from the global flight to safety. The Bank of England, of course, also responded, cutting its bank rate, expanding its asset purchases, and introducing the term funding scheme. Next slide, please. Finally, I might mention that one difference between the monetary policies that the central banks have conducted is that the widespread use of the dollar on international financial markets has meant that the Fed has a sort of a special role to play, providing liquidity in the form of dollars through other central banks or in cooperation with other central banks around the world. So the Fed has established central bank swap lines to provide other central banks the ability to easily borrow dollars in exchange, basically swap their own currencies for dollars. It has created a repo facility for foreign and international monetary authorities, the FEMA repo facility. The ECB has also created a facility to provide euros to non-European central banks to provide liquidity. Next slide, please. All right, so let's briefly summarize the differences. Among the differences, there were differences in the timing or the synchronization of unconventional monetary policy. The Fed and the Bank of England were early adopters of broad bond buying. There were, in the last 10 years or so, there have been somewhat out of sync monetary policy cycles. Unconventional monetary policy has sometimes been done for different purposes by different central banks. So, for instance, the European Central Bank used the Securities Markets Program to help stabilize international sovereign debt markets, not directly to stimulate the broader economy. Central banks have made different choices about types of policies. So, for example, the Fed and the Bank of England have eschewed negative rates, whereas the ECB and the Bank of Japan have used them. There have been bank lending incentive schemes by all major central banks except for the Fed. And sometimes tactics have differed. So the Bank of Japan has employed yield curve control, which none of the other central banks have done, at least so far. Next slide, please. So that brings me to the end of my talk. I'm a little bit over time, but not too bad. So Juan, do you want to take over?
Perfect. Thank you. It's absolutely fine. Chris, thank you very much for your presentation. And I appreciate it was a challenging one. It was a very comprehensive topic, and you made it very clear the similarities and differences across central banks. So thank you very much for that.